All right, so let's look at this Reddit post. So here we're talking about Roth IRA and foreign tax credit / foreign earned income exclusion. So I'm an expat living in Europe, moved in 2025. I have the option of applying either the FTC or the foreign earned income exclusion. My income in 2025 was low, so I understand that the foreign earned income exclusion is a better option in that regard. However, if I willingly choose the foreign tax credit instead, so that my income is not excluded for U.S. taxes per se, but a credit, then would I then be able to pay into my Roth, even though I earned that income outside the U.S.? Yeah, so this is a really good question and a really common one. I mean, there's a couple things to think about here. My personal opinion, especially the people that live in Europe or higher tax countries, is to use the foreign tax credit first. So if the foreign tax credit gets you to the same or equal answer, same or better answer than the foreign earned income exclusion, I opt for the foreign tax credit for a couple of reasons. One is that I think the filing is a little bit simpler. You just have the foreign tax credit and the 1116. You don't have to go through the foreign earned income exclusion and the form 2555, so it's a little simpler. Second, you're not locked into anything, because once you start filing with the foreign earned income exclusion, you have to continue filing it that way. And once you stop, you can't file it again for another 5 years. So with the foreign tax credit, it gives you that flexibility. Another reason is that if the taxes are higher, you're starting to build up some excess foreign tax credits. And some people, like maybe you live in that high tax foreign country for a few years, and then you end up moving to Panama or the Cayman Islands or somewhere where the tax rate's a lot lower. Now you have some foreign tax credit excess that you've used, that you can use in this other foreign country. So it's a benefit you can take with you potentially. Whereas if you use the foreign earned income exclusion, you have to reduce out all those foreign taxes, so they just kind of go away. The other benefit is exactly what they mentioned here, the Roth IRA. So with a Roth IRA, you have to have at least earned income equal to your contribution amount. So if you can contribute $7,000 to a Roth IRA, you need to at least have earned income, so income from services, equal to that $7,000. If you use the foreign earned income exclusion and wipe all your earned income out, now you can't contribute to the Roth. So those are the reasons I typically opt for the foreign tax credit. So in this scenario, that'd be what I'd be advising this person is do the foreign tax credit. You can contribute to the Roth. It doesn't matter that you earn the income outside the U.S. at all. You just have to have that earned income on your tax return so that you can make the Roth contribution. So let's check out some of the comments here. See, if your country's tax rate is at least that of the U.S., use FTCs. And yes, you can pay into your Roth. Exactly. That's what I was advising as well. So I had a great idea of using the foreign earned income exclusion on only part of the foreign income so that I could contribute the unexcluded part to a Roth. Unfortunately, when I got around to filing my taxes, I found that you can only use 100%. And then the next comment, yeah, people tout that idea, but it's not technically correct. So that's a really good idea. What I do for people, so in some cases, the foreign earned income exclusion is better, even in a scenario where you have enough foreign tax credits. And the reason that could be is, let's say you had $20,000 of capital gains and you're married and your standard deduction's $31,000. So if you take the foreign tax credit, you're going to get a full credit against your earned income, but you're still going to be taxable on that capital gain because the standard deduction doesn't wipe it all out, because your standard deduction is going to reduce your total income, which is going to be the earned income plus the capital gain. If you take the foreign earned income exclusion, now your income's all gone. So if that's the case, I would go the foreign earned income exclusion route, but then you can't contribute to the Roth. So in that scenario, I agree with them. It's an all or nothing thing. You have to file the foreign earned income. The foreign earned income exclusion is for all of your foreign earned income, but the move is to make some of your income not foreign earned. So if you have the option to go back to the US for part of the year and work in the US for a little while, you can apportion part of your earned income to the days you spent working in the US. That piece is no longer eligible for the foreign earned income exclusion. So you could work it out to where the apportionable piece of your earned income to the US happens to be $7,000 or whatever Roth IRA contribution you're trying to make. And so you can indirectly achieve the goal that they're saying that is not achievable under this by making part of your income US sourced. So In my example, the move would be to go spend some time in the US, allocate your earned income up to $7,000 of it to the US. So now you'll exclude your income. You're going to have $20,000 of capital gain, $7,000 of US source income. All of that is still under the standard deduction. So you don't pay any tax, but you have $7,000 of earned income to apply to your Roth contribution. So now you've got the best of all worlds, and you can go about your life investing in the Roth and paying no tax in the US. Why is it not technically right for a high enough income, foreign earned income exclusion limit plus IRA contribution, it works fine? Yeah, so I mean, the other answer is just make more money, right? If you make more than $130,000 more than the foreign earned income exclusion amount, if you make $136,000 or $137,000, so now you can only exclude up to $137,000. The additional $7,000 would be eligible for the Roth IRA. So I agree, making more money is your other option for the Roth IRA contribution. But be careful you don't phase yourself out of the Roth IRA contribution as well. And one thing you have to look out for is if you live abroad, a lot of expats, of course, are married to non-U.S. people. And if you're married to a non-U.S. person, you file a separate filing, so married filing separate return, you phase out of the ability to use a Roth IRA at $500. No idea how they came up with that number and why it's so low, but they're obviously penalizing married filing separate type returns. So another thing to look out for if you're abroad and if you're married to a non-U.S. resident, then the Roth IRA in a lot of cases is not an option.